Absa with his quarterly housing review today, and here to take us through it is Jacques du Toit. He's property analyst at Absa Home Loans. Jacques, thanks very much for coming in today. Jacques, we've seen an improvement in house prices over the first 2 quarters of the year, and of course that tied in with the very strong economic growth we saw right at the beginning of the year. That growth looks like it's tapering off at this stage, though. Are we going to see house prices also turning the corner again?
Well, we don't really expect prices themselves to turn the corner, but price growth is definitely on a downward trend if we also look at our most recent monthly house price index. It's to a large extent because of base effects. In the second half of last year, where price growth picked up quite strongly, that will have an effect on your price growth 12 months down the line, and that is what we are currently experiencing.
What sort of growth would you expect in residential property for the year as a whole?
We're looking at around about 10.5% at this stage for the year as a whole. Then that is compared with a slight decline in prices on an average basis during 2009.
So that's 10.5% nominal growth. What would the real house price growth be when you take inflation into account?
Obviously, inflation environment has improved quite a lot in recent times, and based on that, we're looking at 5 to 5.5% real growth in 2010 compared to 2 consecutive years where we've actually seen prices declining in real terms.
Household finance is still very much under pressure. We have household debt still at about 80% of disposable income. The consumer is still not in a very good space. When would you expect that to turn around and that to add a bit of momentum to the house price market? Yeah,
obviously it will depend a lot on the broader economic environment, and unfortunately in the first half of this year we've seen some further job losses in the economy as a whole, so that will definitely influence household income and the ability of households to take up further credit to spend and even take up mortgage loans.
Do you think more interest rate cuts are needed? Because we have had 550 basis points lobbed off the prime rate over the past year and a half. Do you think another interest rate cut would make any more difference?
Well, I don't think it will make a major difference, although over the short term it will give some support to the housing market. Moving forward, we do not really expect rates to be cut any further, but yeah, you can never say never. You know, the economic conditions are not that bright in terms of employment and impact of that on the rest of the economy and the household sector. But yeah, we do not really expect further rate cuts and rates actually to move sideways for the rest of this year into 2011.
Just looking across the different segments of the market, of course you mentioned job losses, which affects really all segments of the market. Are you seeing any variance and increase across the different segments?
Well, especially in the middle segment towards the lower end of that bigger segment, smaller sized housing, we've seen some relatively strong growth in recent months, and it is most probably driven by the affordability issue. Affordability became a little bit of a problem towards the end of 2009 into the early stages of 2010, but so also taking into account rising rates and taxes, water tariffs, electricity prices increasing. So those factors are also having an impact on the cost of running a property. So those are factors that your prospective buyer most probably take into account and shifted the focus slightly towards the more affordable segment.
And when you talk about 10.5% growth for the year, are we talking about the price achieved? Because I know we've chatted to some of the other banks. People are asking a bit too much sometimes for properties on the market, and those properties are sitting on the market for quite a few months.
Yes. Yeah, no, for sure. It can still be the case in certain instances that asking prices are relatively high, taking into account the market conditions. But we feel that 10.5% growth is achievable this year compared to what has already happened in the first half of this year, where we've seen price growth in the first 6 months of this year on a year-on-year basis of almost 12.5%.
Is mortgage finance readily available?
It is readily available, but obviously what the banks will do there is look at the risk profile of the applicant for mortgage finance. So those are factors that we have to take into account, and obviously also the stipulations of the National Credit Act playing a role in this instance.
How has that hampered perhaps the bank's ability to lend to customers?
Well, obviously it had an impact, and taking into account that your customer's average risk profile is at a different level currently compared to where it was a couple of years ago, it has an impact on the mortgage lending industry. And although volumes have picked up in recent months, and over the past 6 months, it is nearly not back to the levels that we've seen 2 or 3 years ago.
And of course, when we talk about 550 basis points coming off the interest rates in the last year and a half, that's not necessarily what customers are seeing there, because banks are pricing for risk and the risk is higher in this market. So they're not getting the full extent of that, are they?
Absolutely. You know, where there were some rate concessions for consumers and prospective home buyers up to 2 percentage points in terms of the variable mortgage rate, it is not really the case anymore. So the banks have also pulled back a little bit on their pricing in terms of rate concessions to consumers.
When would you expect to see a full normalization in the residential housing market?
Well, you know, we do not really expect the housing market go back to the levels that we've seen in 2003, 4 and 5, where price growth was well above 20% and in some instances well above 30%. That was really unsustainable at this stage. So we actually expect price growth over the next year or two of between, I should say, 7% up to 10, maybe 11% on average per annum.
And what are the risks, as you see them at the moment, to a recovery in the housing market?
Well, we do not foresee any further interest rate cuts, so the property market is most probably cannot look forward to any further stimulus coming from the interest rate environment. And if interest rates are starting to increase maybe during the course of 2011 on the back of inflationary pressures, that will put some further pressure on the consumer out there and their ability to get mortgage finance.